Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, December 19th. God, where did this year go? 5:04 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we're in a correction that really kicked in last week after uh, CPI report, Fed announcement, higher for longer message from the Fed about interest rates, and the market does not like it. You can see over here on the trend gauge, we're neutral at best on leaders. Uh, about thir- uh, about a little more than a third of the 21 over 21 dropped off last week, and I had a bunch to replace it. But really, what's the point? This isn't a market that we should be buying stocks in, and a lot of the replacements that I would have put in today took it on the chin too. We'll go through a bunch of charts, but you'll see what I mean when we go through. Short term, all five of the major indexes that we track are below their short-term 21-day exponential moving average, and the slope of the line has rolled over. That is not a good combination. Medium term, 50 barely hanging on to neutral. One of the indexes still above the 50, 200-day. Long term, all five of the major indexes, well, four of the five are below, one, the Dow, still above. We'll take a look at all the indexes like we always do. So what happened today? I have fourth plus, really you could argue fifth down day off of that spike up high on CPI last Tuesday, where we had a negative reversal, closed positive, but well off the highs of the day. For true red days since then. So 4+ down day. We did bounce at 3,800, which is a fairly important key support level. We'll talk why when we get into the tail of the tape. So on the day, G6, this is our 6 ETF growth composite, down 1.7%. S&P down 9/10. NASDAQ 100 down 1.4. Dow down 0.5%. Mid caps down 1.2. Small caps down 1.4, global diversified 60/40 stock and bond down 0.57 in-house. Fortunate to be green again today. Our inverse ETFs are working. We're getting, after being this fifth day down, we took a little bit more of them off and we got stopped at one position that we were still holding on to. Again, we'll go through that when we go through the tail of the tape and take a look at a few other charts. We did open, just about flat today. But we were rallying overnight and pre-market up about 0.4%. But just as we got closer to the open, we just started dripping lower and lower and lower. Opened about flat, and that was 2 points off of the high of the day, and then it was just a trend down day, dripping lower till we hit 3,800, and then we bounced. So let's talk about Revere for a minute before we get into things. Anybody new to us? I want to explain to you that we are an SEC registered investment advisor that is an active manager that trend follows. When the market is in an uptrend, we are as involved as we comfortably can be, especially when we're trending over all three time frames that we track that I talked about on the trend gauge. That's the green line, the short term 21, the red line, the medium term 50, the black line, the long term 200-day moving average. If the market starts to roll over, our positions will get stopped out. We'll see a lack of new opportunities to take advantage of. If we really start correcting for an extended period of time, the slopes of the lines, that's the red line and the green line, will roll over. And if things get really tough, we'll get below this black line. That's the 200-day moving average. Sometimes you bounce above it and below it. But the key day this year was April 21st, when we tried to get back above it, failed, had a negative reversal, and that kicked off the second leg down. And the reason why we want to be so concerned with the 200-day moving average is because of this chart here that shows the devastation that can occur if you get caught in a big negative sequence of returns when you're approaching retirement. And this is our number one job here at Revere, is to preserve capital, whether you're close to retirement or not, because it just makes sense to be able to protect capital, sleep well at night, save your mental capital, your no heartache, and then get back in from a higher capital base, using our signals to get back into the market. The last thing you want to do is get hit with one of these 50% drawdowns like we had in 2000 and 2002 and 2007 and 2009. I say we're fortunate this year to only have been down at the worst 27.5%. I don't know if we're going to break lower and break that. But if you get that back down to there, we bounced at minus 20% again today. We hit that level again today, and that's where we bounced from 20%. You need 25% to get back to even. From 27%, you need 38% to get back to even. So that's why our first job, as I said, is preservation of capital, and then the returns take care of themselves when the market gets back to a healthy posture. And if you're interested in this approach, shoot me an email, don@revereasset.com. You can also email my partner, Dan Stewart, dan@revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. If you hadn't sold and you were breathing a sigh of relief because we had this 12-15% bounce off the bottom, we've given over half of that back now over the last 5 days. Uh, if nothing else, give us a call and we can discuss your situation and explain that it's never too late to sell as long as you have a plan to get back in. That's one of the derogatory things that is said about active managers, is that they have to be right twice. Uh, we've proven over the long term that we can be as right as we need to be exiting and re-entering, and beat a diversified portfolio. And we can show you the numbers if you give us a shout. So reach out to us if you want to. So here's the S&P 500. Uh, here's the first day down, which was a negative reversal off 4,100. So 5 days we've gone from 4,100 to 3,817. Let that sink in. For 300, 283 points in 4 days. That's a lot. Break, and again, fail at the 200-day moving average, fail at the 200-day moving average, fail at the 200-day moving average. And what happens after that? Leg lower, little by little, broke the 21. Now we broke the 50. The slopes of the lines are rolling over. This is when we get defensive. Been talking specifically about it for the prior 3 days, prior 3 trading days, and we've just accelerated to the downside now. But we are at an area which is a natural area to take a break to the downside. That's that 3,800 area. And again, we'll talk a little bit about this when we get into the tail of the tape. So NASDAQ 100, even worse, further third close now below the 50-day moving average. We're at 269.75, 254 is the prior low of the correction. Not looking too spiffy there on the old NASDAQ 100, led by these big FANG stocks down. So here's the Dow holding on to the 50, holding on to the 200. We've got a double level of support here right above 32,700. See if we can hold that. Dow, you'll notice it's showing relative strength since the beginning of last week when we started to show off, and that's natural. When we started to sell off, the Dow is showing off while we're selling off. Note the relative strength line. It's where it is. It's equal to where it was back here, which was at the high. So really showing positive strength during this sell-off, which is, it's the most defensive index. That's what it's supposed to do. That's what it's doing. MDY mid caps held up strong for a while, but not for the last 4 weeks, and certainly not this week. 3 closes below the 200, 2 below the 50 now. And small caps, which again, kind of moved with mid caps, were strong for a little bit, now weak for 5+ weeks. Weak for 5 weeks, broke the 50, broke the 200, broke the 21, 3 closes below the 50 now. The weakest of the index is very oversold, but you can stay oversold for weeks. You can see this is a 2-week period, a little bit of a bounce, then in a 3.5-week period. First, we have to stop going down. We haven't even started doing that yet. Let's look at the equal weights. First, the S&P down 1.2, actually a little worse today than the S&P 500, now breaking below the 50-day moving average. For a while, everybody was saying, oh, there's nothing to worry about. The equal weight is above the 200-day moving average. Well, it's not anymore, and now we broke the 50-day too. Yes, that's exactly how all their voices go. Oh, well, okay. QQEW, even weight, sitting right on the 50-day moving average, so not as bad as the equal weight NASDAQ 100. How about the dollar? Even the weakness in the dollar cannot get stocks moving. It's been trending below the 80 MA for 4 or 5 weeks now, near the bottom of the range, really down in this 7 tenths to 9 tenths of a percent all day long. But we couldn't muster any strength except for this last 20-point bounce into the close on the S&P 500. So imagine if the dollar starts strengthening, how difficult things could get for stocks. Let's take a look at the VIX. The VIX is not concerned, still hanging around the 21, actually down today with the market down. So, and that's not showing fear. It's just really little by little selling by institutions as they're trying to decide what kind of evaluation they should put on the S&P, depending on how earnings are looking when they start to be reported in the first quarter and what the outlook is for the rest of the year. So no panic yet. Again, if this bounces the same way that the put call could bounce, the same way that the dollar could bounce, we could sell off extremely hard. And considering where we are under the 200 and the rest of the indexes, it's not a time to be a hero. Certainly not a time to be a hero. Let's see the other tickers that we want to look at. Let's go to the yield on the 10-year TNX. Bond prices were down today, which means the yield was up. So you can see the 10-year coming into the downtrending 21-day exponential moving average. This has controlled the trend for the last 5 weeks. We're coming to a part where it's either going to break through or roll over again. You can see we're coming off of oversold on the yield. So we've got a long way to go to get back to overbought. Not that we always go there directly, but you can see these lines. They pretty much are self-explanatory. When a trend starts, sometimes you just got to get out of the way and let the trend play itself out. How about the 30-year TYX? And right into the declining 21 day and stopped there, coming off of oversold also. Looking like it wants to go higher, but got to get through the declining 21 first to at least change the trend. BND, this is broad bonds, just the opposite of what you see with yields pulling back to the 21. How about junk bonds? Down quite a bit today with the gap down. So this is a change in character for junk bonds. They were holding up better than stocks, down more than stocks today, sitting on the 50-day moving average. So this 5 week trend of junk bonds holding the 21-day moving average broke today. That's not a good sign for stocks. Gold. What did gold do today? Well, the dollar was down, so gold should be up. Nope, gold was down today, 0.28%. Cannot get above the 200-day moving average. How about gold stocks? Down hard today, 3.3%. In fact, breaking the 21-day moving average that they were above for 5 weeks. So that's a change in trend too. You get a warning about these change in trends when the stochastic starts to roll over. Sometimes it does. This was a false breakdown, another false breakdown. Now this is looking like a real breakdown with a move. We couldn't get above the 200-day moving average with any significant strength. Pulled back, bounced 2 days at the 21, but now we broke below the 21. That's a change in character for gold stocks. Silver. IHO Silver was leading for a while, still pulling back, but a reasonable pullback. Hasn't even touched the 21 yet. I'm not even going to look at Bitcoin, frankly, because all right, I will. I don't really care, but 1.7%. Sam Bankman-Fried was in a Bahamian jail today. He was supposed to be extradited, but to the U.S., but now he's arguing that he doesn't want to. Apparently, those jail conditions aren't very friendly in the Bahamas, and he's pretty soft based on the life that he's lived. So those are all of the key charts that we want to look at. Now let's go to the tail of the tape. Headwinds. Those macro headwinds haven't changed. The technicals have gotten substantially worse over the last 4 or 5 sessions. Put call at 1.05, that's neutral. VIX, again, up on a down day, hanging out around this 21, can get a lot worse. Fear and greed down to 39. We're off the bull case onto the bear case now. A little bit of news: U.S. is to begin refilling the strategic petroleum reserve that was drained to bring oil prices down, uh, to make people feel less bad going into the election. That's the game of politics, like it or not. Uh, Oil initially gapped up on the day because this will really suck some more oil out of the system, but it reversed by the end of the day. Actually, USO didn't. USO ended up 1.8%, so oil itself did, but the producer companies down 1.6, while the oil services were barely positive. Let's see, day count down 3 plus to down 4 plus. Friday, we got some PCE inflation data that the Fed pays a lot of attention to. This really hadn't seemed to move markets much, but again, the Fed is paying attention to it, and inflation has kind of taken a back seat to fears about recession over the last week. Expectations coming in today were negative because we're under all the MAs, but a short term bounce is likely with the down 3 day count, but down again today, bouncing at 3,800 support. There's where we bounced. Support for the Qs closed right at support, basically. Let's look at the 5 minute on the S&P, and you can see what we're talking about with what we did today. So uh, opened right at 38.53. A little bit of a move down, 38.45. Tried to rally, couldn't get above where we opened. High of the day, 38.55. Then just dripping lower and lower, making lower highs, lower lows. It accelerated after 1:30 today. You can see this is just we call this a frozen slope lower. At least we were consolidating in here for a while, but then frozen slope lower down to 3,800. Why is 3,800 key? Because 3,800, 3813, let me draw the line here. 3,800, look across to the left. 3,800 was support here. We broke it here, got back above it. It was a battleground area all throughout June and July. Then we started to rally. We came back, held for a couple times, got back below it, tried to rally. It turned into resistance, another leg down. Then we bounced. Got back above it one day, and then all the attempts to sell off. This is one of the reasons. This is one of the spots where we got chopped up a little bit on this return at Revere here. 6 straight days where 3,800 held. Then it broke back below it, and then another gap lower. But then we started to rally off of there. Got back above 3,800, failed again, another close below the moving averages, and then this big gap up on 11:10. That was a change in character. That was when Powell had his press conference and he was all happy and not acting hawkish at all. And we consolidated off there, made another leg up on some weak CPI data before we started selling off. Then we got some more CPI data and started to sell off, and then hawkish Powell higher for longer. You can see where we went from there. So 3,800. Now this is where we bounce. This is 3813 is a 20% loss from year to date. So that's one of the reasons why it was significant before, especially here, this 3810 level. This is pure bear market. We come down, we hit minus 20% and we bounce. It was a natural place to bounce. Those natural places to bounce carry forward on the chart because they're reference points going forward. So that's where we bounce today. That is also let's see, it's 3815 is also a key fib. That's a 38.2% retracement of the entire COVID move up. 38.2 is a key fib. So we came back down to it. That's another reason why we bounced and played ping pong around these areas over the last 6 months. Bounced there again today. A break below 3,800 is not going to be a good sign. Back to the tail of the tape here, and we can see what's below 3,800. If I can get my hold on one second. Let me get my data corrected here. So let's bring it back down here. So below 3,800, we go all the way down to this 3,600 to 3,575 to 3,600 level. That is 25% down year to date. There's actually one other spot in here. Hold on one second. The 200-week moving average is at, I am not doing a good job here. There it is. 3662 is the 200-week moving average. We bounced there in the past also, but not a lot of support under this 3,800 area. Um, some down to, but looking back at the chart here, we bounced around a little bit between 3,600 and 3,800. We get back into there. Not a lot of support, and then if we break down, uh, well, we're all in cash, so if we break down, we'll be compounding from a higher low. But I'm pointing out the pitfalls of going lower. So what was strong today? Just bond yields, OIH, KBE, XLP was down less than the market. Uh, Dollar weak, the three CKY, the three tech sectors weak, semiconductors weak, software weak, biotech weak, GDX weak. Here's the five tickers that we'll go over, as well as a monster gap up on a biotech phase three, not phase three, is their trials. Maybe it was phase three because they're petitioning for approval now with the FDA. The trades that we did defensive selling as five broke down. We'll look at the chart momentarily, and offensive selling as TZA and FAZ got extended to the downside. Those are inverse ETFs, so we booked the gains there. Bottom line, 4+ days down, found support at this prior key level, 3,800. Here's where we are. Here's where we bounced. It's a fib. It's minus 20% year to date, 3,800 round number. We sat there at 3,800 for a couple of hours today, and that within 5 or 10 points of it before the little bounce into the close that got us to 38.18. So again, no time to be a hero in this market. So let's go to the charts. First of all, what we still own in house, Boeing continues to trend higher along the ADMA, was positive all day today. Really good volume patterns here over the last 2.5 weeks. Any sell-off days have been on well below average volume. Accumulation days, relative strength acting well. This stock is acting like it doesn't even know that there's a correction going on. One that found out there was a correction going on today was Five. This was one of my plays that I did based on the gap up. Bought it while it was still inside. Added a little bit more on the bounce off the ADMA, but that was before the market rolled over, and the market gets them all. So we bounced at the 8 the way we should have. Negative reversal. We stopped on the first half last week, and now the break of the 21. We stopped on the other half today, minus 0.12% versus the overall AUM. So just a tick worse than the 0.11% that we try to keep for a quarter of a position. Mobileye, where we have a 1% size in this. Uh, Good day today. Still can't get no closes below the ADMA. We took half of this off last week to reduce our position down to 1% because of the market. TMDX, we've talked about the story, didn't have a good day today. Volume slightly above average. We have it sized so that even if we lose 10%, it has to get below the 50-day moving average to be a 10% loss. Based on where we bought it, that'll be our minus 0.1% of overall capital. We're holding on to this because of the story right now, seeing if it bounces at the 50-day. TMDX, so FAZ, you can see how this got extended to the upside today. We took 3/4 of it off last week. It pulled back today, showed more strength in the afternoon, but look at KBE. Banks just continuing to make a lower low. Uh, that just, I mean, it's really extended to the downside. So I'm expecting a bounce at some point. They don't continue to go straight down forever, do they? I always say they don't. XLF extended to the downside also with the rollover. So we locked the profits in because, well, we bounced at 3,800 when that started. When we got back above 3,810, I started taking some of these off. The other one was IWM. When we bounced at 3,800, we were long TZA, which is the 3 times inverse. that ran into the 200-day, but you don't really look at the chart of the triple because it's a derivative. You look at the chart of the underlying. The underlying is IWM, 5 days down, extended to the downside more than about 3%. 3 times 3 is 9, so we could lose 0.9% or 9% if we move back up just to get to the 80 MA on small cap. So I never try to overstay my welcome on the short side when we get extended to the downside, because when it bounces, you're giving up the gains that you got versus the index going lower. Uh, and I just you got to book gains in this market. The playbook has been to sell strength, and in this case, selling strength meant selling strength in the inverse as it got extended to the upside. And buying weakness is okay while you're holding support, but support gave way last week on the indexes. So uh, time to book the gains in. So all right, a couple of charts we'll take a look at now. This 20, I keep my universe list, and there were a lot that actually so many that I couldn't decide on 7. I said to myself, let's see what we end up doing on Monday. So what we're going to do is focus on this column right here, price versus the 21-day exponential moving average. There's over 20 that are still above the 21, but lots of them down. Look at the price percent change that these things are down today. They were above the 21, which makes them a leader from a relative strength perspective. But do you want to be holding stocks that are above the 21 that are down 3, 4, 5, 6, 7? As much as 9% today? Let's go through them. Smartsheet, I mean, this looks great, but the market's not right. EXAS, biotech had a big gap last week, closed below the low of the gap. That's not supposed to do that. GTLB, uh, showing relative strength, trying to get back above that 50 level, down 9% today. AXSM, only down 3%, flat base, but stochastic rolling over. 4 Schiffer payments looks great. Stochastic starting to roll over. The volume patterns are excellent on this. This is really, and it looks great, but the market's just not right. BMRN trending higher along the 8. This is what we wanted FIVE to do when we bought it. Biotech stocks are holding up pretty well, relatively speaking. Look at the volume patterns on this. This is another. It's just acting perfectly, honestly. Oh, I didn't show that stock that gapped 200% today, MDGL. So uh, think of cirrhosis of the liver, but not blamed on alcohol. That's what this. Uh, that's what it's a large target market, and that's what this is. This drug is designed to had fantastic results. When you see something up 268% on 2,569% volume, you better put it on your watch list. Yeah, they lose money. Yeah, they have no sales. Well, they're about to have sales in a major way if this gets the final FDA approval. So, no, not buying it. Very volatile intraday between 200 and 2. At the high was 236 today. So we're not going to get into it, but we'll wait for the 8 to catch up like we always do when the market is questionable. I'm not going to chase it after a higher high either because of the market, but definitely something that needs to be on every growth investor's list. So back to the list, BMRN, I showed that PDD, Chinese stock, acting fine, but the 8 starting to roll over, as well as the stochastic. NVO, riding the 8 higher the way it needs to. Stochastic now rolling over, first close below the 80 MA. PEN, first close below the 80 MA, stochastic rolling over. Moderna, gap last week, closed below the low of the gap. Did it? Or did it break below the low of the gap here? 184. It's at 189. It's still above the low of the gap, but 2 big volume up days. Good story on a cancer vaccine. Stochastic rolling over. Again, not the market to be a hero in. And I'm going to wrap this up with these builder stocks, but the stochastic is rolling over on them. They gapped. They had upgrades and good responses to earnings last week, and their relative strength is superior. There's 3 of them: Toll, DHI, DR Horton, and Lennar, LEN. Great reaction to earnings on Lennar. 2 days of a pullback after it, though. Stochastic rolling over. Let's give one more. Yum China. Uh, Again, Stochastic rolled over, broke the ADMA for the first time. Okay, just one more, and this time I mean it. AVGO, this is holding up better than NVIDIA, which we bought and got stopped out of last week. That's going to wrap it. As always, love to hear your feedback. Don at revereasset.com. The phone is 855 Real Wealth. Remember, this chart, it's not how much you make in the market, it's how much of that you can keep, especially when you're under the 200-day moving average, and we failed to get back above it last week. It's significant. Um, these historical numbers just prove that it's significant. So if you don't care, you don't care. You're not even listening to this video, but I think you do care. And as long you can, it's like I said, it's never too late to sell as long as you have a plan to get back in. So that's going to wrap it. Finishing up Monday, 12/19. This is Don Vandenbord telling it like it is. Thanks for listening and have a great day.